Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be talking about FAR Area 2, and this is Section H2, and this is an application topic. Perform debt covenant calculations as stipulated in a debt agreement to ascertain compliance. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, if this is the first time you're seeing anything from us, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. The link is right here on the page, that strategic study link. That will take you to the webinar. It is only 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam. We will show you how to be effective and efficient with your studying so you don't waste months or even years of your time failing these exams. So again, make sure you go check that out. And also just letting you know, we will only be going over 5 questions in today's video. And for this video, that's the only amount of questions that we're going to be doing. I'm not going to be making a 10-question version of this video because this topic is pretty straightforward and you won't see too many questions on this most likely. You may see a sim on this or maybe a few multiple choice questions though, so that's why we're going over it. But normally for these YouTube versions, we do 5 questions and then I make 10-question member versions so that SuperfastCPA Pro members can access those 10-question videos and get more practice and more understanding. So if you like this and you like our other videos, make sure you check out becoming a SuperfastCPA Pro member, where you get access to the Pro course, which is where we explain everything super in depth. We teach you how to do every part of the process so that you know exactly how to study every day strategically. But on top of the Pro course, now you can access the 10-question member versions of these videos. So again, you can get more practice if you become a SuperfastCPA Pro member. Again, in this case, we're only doing 5 questions, and the member version is also only going to be 5 questions, but normally they're 10 questions. With all that, let's dive into these 5 questions together. All right, here we are at question 1. And something we always like to point out with these questions is you always want to go to the last part of the question first. You have no idea what you're going to be seeing on test day. So if you read the last part of the question, a lot of times it will give you context for what the question is even about. In these questions, it might seem a little bit silly because we're going over the same things over and over again. But again, this is a really good habit to be in for test day when you have no idea what you're going to be seeing. So you want that extra context so that as you're reading through the question, you already know kind of what you're looking for. You already have an idea instead of reading through 1 or 2 paragraphs of information without actually knowing what you're reading the information for. So again, read the last part of the question first. It will give you context. So let's read the last part here and then go up to the top. Based on the covenant requirements, what is the maximum additional debt Greystone can incur? Okay, let's go up to the top. Greystone Corporation has a debt covenant with its lender that requires maintaining a maximum debt to equity ratio of 2.5. Currently, Greystone's total equity stands at $8,450,000, and its existing total debt amounts to $17,200,000. Greystone plans to finance a new project through additional borrowing and needs to determine the maximum amount of new debt it can take on without violating its debt covenant. So again, based on the debt covenant requirements, what is the maximum additional debt Greystone can incur? Now, one thing I will say with all of these questions, they're really not too difficult. The main idea is that you need to know what this even looks like. You need to know what complying with a debt covenant is. So that's why we're doing these 5 questions, to kind of teach you some of the different ratios that you're going to have to know and you're going to have to be able to calculate so that you can tell if a company is in compliance with whatever the requirement is. But again, this question is not too difficult, especially if you remember how to calculate the debt to equity ratio. So pause the video, do this on your own. I think most people could do this just based off of the information here. If you have no idea though, that's okay. Again, we are using the questions to learn how to do this material. So if you don't know how to do this, that's okay. We're going to look at the answer together to learn what we're supposed to be doing here. All right, here we are. The answer is A, $3,925,000. That is the amount of extra debt that they can take on and still be within compliance. So let's walk through this. The debt covenant limits Greystone to a debt to equity ratio of 2.5 with total equity of $8,450,000. Greystone's total allowable debt is calculated as follows. And I thought this was a pretty cool way to do this, so I wanted to share it with you. And maybe a lot of you have already know you can do this, but maximum allowable debt, $8,450,000, multiply it by the max that they can have, so 2.5. 2.5 is $21,125,000. So that is the max amount of debt that they can have compared to their equity, because their equity is $8,450,000, and 2.5 times of that is that $21,125,000. So we can easily see what their max debt is. So looking at their current debt, $17,200,000, we can then easily calculate how much more debt they can take on and still be within compliance. So you take that $21,125,000, subtract $17,200,000, and that gives you $3,925,000 of extra debt they can take on throughout this year and still be within compliance with this debt covenant. So again, not too difficult of a calculation and not too difficult of a concept really, but again, I wanted to make sure we go over it so that you're prepared for test day, because you could see some questions on this. You could see a sim on this where you have to calculate a whole bunch of these at the same time. So with all that, let's go to the next question. All right, here we are at question 2. Based on these figures, does Hawthorne meet the covenant requirement for its interest coverage ratio? Okay, let's go up to the top. Hawthorne Industries is evaluating its financial compliance with a debt covenant that requires maintaining a minimum interest coverage of 4.5. For the year, the company reported net income of $1,750,000, tax expense of $500,000, depreciation expense of $1 million, and interest expense of $500,000. So with all that information, again, we have to figure out if they are meeting their requirement of the interest coverage ratio being 4.5 or greater. So if you remember how to do this, again, it's not too difficult of a calculation. Pause the video, do the calculation yourself, and come back when you're ready. And if you don't remember how to do this, that's okay. Again, we are using these questions to learn. So let's go ahead and look at the answer if you haven't already paused the video to try to do it on your own. All right, here we are. The answer is A, yes, with an interest coverage ratio of 5.5. So yes, they are within compliance because they have an interest coverage ratio of 5.5. Now, just a reminder, the interest coverage ratio is also, another name for it is the times interest earned ratio. So if that's what you were thinking of, or if you weren't sure if those were the same thing, yes, they are the same thing. So what you do is you calculate EBIT, which is earnings before interest and taxes, and then you can then divide that by the interest expense. So it's pretty easy to figure that out with what we were given. You take the net income, which is, the income post-tax, post-interest, and so you add back the tax expense that we were told, $500,000, and you add back the interest expense that we were told, again, $500,000. So $1,750,000 plus $500,000 plus $500,000 is $2,750,000. That is their EBIT. And then we use that, we divide it by $500,000, which is the interest expense. And that means that with their earnings before interest and taxes, they can cover their interest expense 5.5 times. So they are definitely within compliance. To be within compliance, they only had to have a 4.5 interest coverage ratio, or again, it's a times interest earned ratio. Same thing. They're definitely above that. So they are within compliance of this debt covenant. Now let's go to the next question. All right, here we are at question 3. Does Astrotech meet both debt covenant requirements? Okay, so it looks like we're dealing with 2 of them at this point. Let's go up to the top. Astrotech Corporation has a debt covenant requiring both a minimum net working capital balance of $1,500,000 and an operating cash flow ratio of at least 1.2. Below are the company's account balances at year end. So they had cash and cash equivalents of $400,000, accounts receivable $950,000, inventory $800,000, prepaid expenses $50,000. They had accounts payable $600,000, accrued expenses $300,000, short-term notes payable $400,000, and they had operating cash flow of $1,200,000. So again, with all that information, are they meeting both the debt covenant requirements? Are they meeting the net working capital balance that they have to be at? And are they meeting the operating cash flow ratio that they have to have? So do these calculations if you can remember how to do them. These are things that you're going to need to know how to do. So if you don't know how to do them, make sure you pay attention to this question. But if you do know how to do these, or you think you do, pause the video, do the calculations, and come back when you're ready, and we'll look at it together. All right, here we are. The answer is D. No, they fail to meet either of the requirements. They do not meet both the net working capital and the operating cash flow ratio requirements. So let's walk through this. Again, you very well may see a sim kind of like this, where you're seeing multiple things that you have to calculate to see if they're in compliance with these like 2, 3, 4 different covenant requirements. So let's go through this. To evaluate Astrotech's compliance with its debt covenants, we have to calculate both of them to see if they are in compliance. So the net working capital requirement, remember, net working capital is calculated as current assets minus current liabilities. So their current assets is the cash, the accounts receivable, the inventory, and the prepaid expenses. So you add that all up together, $400,000 plus $950,000 plus $800,000 plus $50,000 is $2,200,000. Then you figure out the current liabilities. That's their accounts payable, their accrued expenses, and their short-term notes payable. So you add that all up together, $600,000 plus $300,000 plus $400,000 gives you $1,300,000. So with that, we can then calculate their net working capital. Their net working capital is $900,000. $2,200,000 less $1,300,000 is $900,000. So what does that mean? That means they did not meet the minimum requirement of $1,500,000. So in that sense, they are not meeting that requirement. They are out of compliance with that part of the covenant. Now let's go to the bottom here. Operating cash flow ratio requirement. The operating cash flow ratio is calculated as operating cash flow divided by total current liabilities. with an operating cash flow of $1,200,000 and total current liabilities of $1,300,000, the operating cash flow ratio is 0.92. So 1,200,000 divided by 1,300,000 is 0.92. So what does that mean? That means they are also not meeting that requirement because they were supposed to have at least 1.2. So we can see here that they aren't meeting either of those requirements, so something bad might happen because of that. But with that, we went over two different things here, the net working capital requirement and the operating cash flow ratio requirement. Now let's go to the next question. All right, here we are at question 4. Based on these figures, is Brightwave in compliance with the minimum current ratio requirement? Okay, let's go up to the top. Brightwave Corporation has a debt covenant that requires maintaining a minimum current ratio of 1.75. Below are Brightwave's account balances at year end: cash and cash equivalents $300,000, accounts receivable $1 million, inventory $900,000, accounts payable $500,000, accrued expenses $400,000, and current portion of long-term debt $700,000. So again, with all that, we have to figure out if they're meeting that minimum current ratio requirement. So pause the video, do the calculation. I think this is something that most people know how to do. The current ratio is something that most people know how to do. So pause the video, do the calculation, and when you're ready to come back, we will look at it together. All right, here we are. The answer is D, no. They have a current ratio of 1.38, so they do not meet the requirement. So let's do this. Again, the current ratio is something very simple. I think most people know how to do it, but let's do it. The current ratio is calculated as current assets divided by current liabilities. Brightwave's current assets include the cash, the accounts receivable, and the inventory. So that's $300,000 plus $1 million plus $900,000 gives you $2,200,000. And then the current liabilities, that's accounts payable, accrued expenses, and the current portion of long-term debt. So that's $500,000 plus $400,000 plus $700,000 gives you $1,600,000 of current liabilities. So you divide the current assets of $2,200,000 by the current liabilities of $1,600,000, and that gives you 1.38. That is not enough. That is below the 1.75 current ratio requirement that they have to meet for this debt compliance. So again, these are not too difficult of calculations. You just need to be able to pay attention and see what they're asking for, and you can usually pick it out pretty easily. Now let's go to question 5. All right, here we are at question 5. What is the additional interest expense Vertex will incur by the end of the year due to a possible covenant violation? Okay, let's go up to the top here. Vertex Solutions has a loan with a debt covenant that requires maintaining a maximum debt-to-equity ratio of 2.0, or just 2. At the beginning of the year, Vertex reported the following balances. Total debt of $15,350,000, of which $13 million is attributed to the loan with the debt covenant requirement. So the loan that has the debt covenant requirement is the $13 million loan, but the maximum debt-to-equity ratio is going to take into account all of the debt. And the total equity is $7,420,000. During the year, Vertex took on additional debt of $1,275,000 and increased equity by $535,000. If Vertex violates the debt covenant, the interest rate on the loan balance will increase by 2% as of year end. So with all that information, if they did violate the covenant, what is the additional interest expense that they're going to have at the end of the year? So pause this video. Again, I don't think these are too difficult of questions. I'm just trying to kind of familiarize you with what you might see on test day. So pause the video, come back when you're ready, and we'll look at the answer together. All right, here we are. The answer is A, $260,000 is the extra interest expense that they're incurring by violating the covenant. So let's go through this. To determine if Vertex is in compliance with its debt-to-equity covenant, we first need to calculate Vertex's year-end debt-to-equity ratio. So again, this is not too difficult. You take the beginning debt, which was $15,350,000. You add the $1,275,000 that they added throughout the year. So that's $16,625,000 of debt at year end. And then you do the same thing with the equity. You take the beginning equity of $7,420,000 and you add the equity that they added throughout the year of $535,000, and that gives you $7,955,000. So now we can use that to calculate the total debt to equity ratio. Very easy. You divide the total debt by the total equity. So $16,625,000 divided by $7,955,000 is about 2.09. It's like 2.08 something, but it rounds up to 2.09. So that is their total debt to equity ratio. Remember, the covenant required that they had 2 or less. Since the debt to equity ratio of 2.09 exceeds the maximum allowed ratio of 2.0, Vertex is not in compliance. Due to this violation, the interest rate on the $13 million loan increases by 2%. So if you had gotten confused by this, remember that the $13 million loan is the one that has the debt to equity ratio requirement, but you're not going to be calculating that 2% extra on all of your debt because not all of your debt is under that requirement. You're just using all the debt to calculate the debt to equity ratio so that you can then know if you need to apply the 2% extra to the $13 million loan. So 2% of 13 million is $260,000. So as of year end, they are incurring an additional $260,000 interest expense. Now, is that the kind of thing where they're recognizing that right away, or are they going to recognize that over the course of the rest of the loan? That's not what we're really concerned with here. What we're concerned with is that they had a consequence for not meeting their debt covenant requirement. Because they didn't meet the debt to equity ratio, they have more interest that they have to pay now. So this is the kind of thing that can happen if companies don't meet their debt covenant requirements. They might get defaulted on the loan. They might have to pay extra interest. They might have to pay it off sooner, different things like that. That's the kind of stuff that you need to know for the exam. You need to know how to calculate whatever debt covenant requirement they throw at you, and you might need to calculate it multiple times, and you may even need to know what will happen if that is not met. So with all that, we've gone over a lot in just 5 questions. Before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You see 2, 3 questions trying to teach you how to calculate the debt to equity ratio for these requirements for debt covenant requirements. Or you might see 2 or 3 questions about something else and it keeps popping up. And again, these are the things that you see in multiple questions. So they're important. These aren't really the things that you see one time, like one question about one small topic. You are more focused on things that you see consistently throughout the questions that you are going through that day. So you take a moment, you write down these pillar topics in your own words, kind of summarizing the most important things that you learned. And as you're doing this each day, you are creating this kind of personal repository of the most important things that you need to know for the exam. So that's why we do the pillar topics. Now let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. So first off, in case we didn't really talk about it very much, what is a debt covenant? A debt covenant is a condition set by lenders in loan agreements requiring the borrower to meet certain financial metrics to reduce risk and ensure the borrower's financial health. So they have this kind of as a safeguard to make sure that the borrower is doing their best to, stay financially secure and financially healthy, because the lender doesn't really want to give money to somebody who's going to default on the loan really quickly and things like that. Now, what happens if a debt covenant isn't met? We talked about this in question 5. If a debt covenant is violated, the lender may impose penalties such as increasing the interest rate, demanding accelerated payment, restricting future borrowing, or declaring the loan in default. So a whole bunch of different things can happen if you default on the debt covenant for a loan. So it's a bad thing that you don't want that to happen. So that's why we learn how to calculate this so that companies can avoid this. Next, let's talk about the debt to equity ratio. By the way, this seems to be the most common thing that you might see out of all these different ratios we talked about. You may still see some other ones, but the debt to equity ratio seems to be a big one. The debt to equity ratio measures a company's financial leverage by comparing the total debt to total equity, helping assess the company's ability to meet long-term obligations. And this makes sense why it would be such a big one, because lenders don't want to give money to somebody who's just taking on a ton of debt and they don't really have much equity, because that means that they're very highly leveraged, which is kind of dangerous. So they don't want to lend to somebody who has too much debt compared to their equity. And then finally, there are some other common ratio requirements in debt covenants that you might see. Debt covenants frequently include ratio requirements like the current ratio, and again, that's current assets divided by current liabilities. The interest coverage ratio, or another name for that is the times interest earned ratio, and that is EBIT, which is earnings before interest and taxes, divided by the interest expense, and the operating cash flow ratio, which is operating cash flow divided by current liabilities. So again, with all that, those are the pillar topics about this part of the blueprints. And with that, we've gone over these 5 questions. Remember, we're only going over 5 questions for this specific topic because there doesn't seem to be too much more that you need to know. So we're not going to do a member version where there's 10 questions this time. But remember, as we close this video, members do get access to the 10 question versions that we make of these YouTube videos. If you become a SuperFast CPA Pro member, you get access to a ton of great resources, mainly the Pro course where we teach you super in depth on how to do every part of the study strategy. But also you get access to the full versions of these videos where I go over additional questions for SuperFast CPA Pro members so they can get more practice and a little bit more understanding compared to these 5 question YouTube videos. So if you like all this, make sure to become a SuperFast CPA Pro member. Remember to check out our SuperFast CPA training webinar on superfastcpa.com. We will teach you for free in 1 hour some key strategies that you need to know and you need to apply for your exam study process. So with all that, I hope this was helpful. Thank you for watching. If you liked the video, make sure to like it and leave a comment, and I will see you in the next video.